let's just jump right in with a classic exam scenario. Take a look at this. You've got a salary of 5 lakh rupees and a loss from your house property of 3 lakh rupees. And the question is simple. What is the taxable income? Seems pretty straightforward, right? What's your gut reaction here?
If your brain immediately went, easy, 5 lakh minus 3 lakh, that's 2 lakh, then hey, you're not alone. That is the most logical, most intuitive answer. It's what probably 90% of students would jot down without even thinking twice. And it is completely 100% wrong. This is one of ICAI's absolute favorite little twists. That tiny, overlooked rule is literally the difference between getting the question right or wrong. And trust me, these are the details that separate the top performers. But don't you worry, because by the end of this explainer, this kind of thing will never ever catch you out again.
So let's get right into it. We're going to master the provisions for the set-off of losses. We'll break down all the rules, we'll expose the traps, and we're going to build a foolproof method so you can tackle any question that ICAI throws at you.
First things first, let's set the stage with a really practical exam-style case study. We're going to use this problem the whole way through to make all these rules totally crystal clear.
So, meet Mr. A. He's got a salary of 4 lakh, a loss from a let-out property of 2,20,000, a business loss of 1 lakh and 80,000 in bank interest. Our job? Compute his total income. I promise you, by the time we're done here, you'll be able to solve this with your eyes closed.
All right, so before we can solve anything, we got to get the fundamentals down. Let's talk about the 2 basic ways you can adjust losses. So what even is set-off? Well, it's actually pretty simple. It's just the process of adjusting your losses against your profits in the very same year. The whole point is to bring down your overall taxable income. Just think of it like balancing your own financial books for tax purposes.
Now, I want you to think about these 2 types as family adjustments. It makes it way easier. First, you've got inter-source set-off under Section 70. This is like adjusting within the same family. Say, a loss from your textile business can be set off against the profit from your printing business. Why? Because they're both under the same head, profits and gains of business or profession. Then you have inter-head set-off under Section 71. This is adjusting between different families. This is where you set off a loss from one head, like house property, against income from a totally different one, like salary. And let me tell you, this is where most of the tricky rules are hiding.
And that, my friends, brings us to the single most important part of this topic for your exams: the exceptions, the restrictions, the you can't do that rules. These are the rules that ICAI absolutely loves to build their trick questions around.
Okay, I need you to really focus on this slide. First up, and this is a classic, business loss can never be set off against salary income. I mean, ever. Second, capital loss, whether it's short-term or long-term, is super picky. It can only be adjusted within its own family. You can't go setting it off against your salary or business income. And third, speculation loss is even stricter. It can only be set off against speculation profit, nothing else.
Let me say that again, because this is a key area where marks are just thrown away. Your salary income, think of it like a fortress. It's protected by the tax laws. You cannot use your regular business losses to lower your taxable salary. Please remember that.
Here's a typical exam-style problem for you. You've got a short-term capital gain of 80,000 rupees. Great. But you're also carrying a long-term capital loss of 30,000 rupees from a previous year. So what's your taxable capital gain? Go on, take a second. What's the number that pops into your head if you did 80,000 minus 30,000 and got 50,000? I'm sorry to say you've just fallen right into one of ICAI's favorite traps. This is exactly how so many students lose marks on what looks like a super easy question. And boom, this brings us right back to that trap from the beginning. Inside the capital gains family, there's a really important rule. A short-term capital loss, he's pretty friendly. He can be set off against both short-term and long-term gains. But a long-term capital loss? Oh, he's a snob, a total snob. It will only be set off against a long-term capital gain. It refuses to even talk to short-term gains. So in our problem, that 30,000 rupee LTCL cannot, under any circumstances, touch the 80,000 rupee STCG. The taxable gain is the full 80,000, and that 30,000 rupee loss, it just gets carried forward. I guarantee you this one rule will be tested. Each one of these losses lives in its own little bubble. A speculation loss will only set off against a speculation profit, and ICAI just loves to give you a speculation loss next to a regular business profit to see if you'll fall for it. We've already talked about the long-term capital loss. And the loss from owning racehorses, it only cares about income from, well, owning racehorses. And a loss from a specified business under 35 AD can only be set off against another specified business profit. The big takeaway here is that these 4 just don't mix with anyone else. Take a screenshot of this, memorize it. It's going to save you so many marks. All right, so we've tried our best. We've tried setting off the loss within its own family, and then we tried setting it off against other families. But what if there's still a loss left over? We don't just throw it away, right? Nope. This is where we get to carry it forward to future years. But, and this is a huge but, there's a major condition attached. This is probably one of the most critical procedural points in the whole chapter. Section 80 is crystal clear on this. If you want the right to carry your losses forward, you have to file your income tax return for the year of that loss on time. And on time means on or before the due date under Section 139(1). This is completely non-negotiable. Let me just say it as plainly as possible. No on-time return, no carry forward. It really is that black and white. If you file your return just one day late, your right to carry forward any business loss, speculation loss, capital loss, or that racehorse loss for that year is just gone. Poof, vanished. The department is incredibly strict about this. But of course, this is income tax we're talking about. Just when you think you've learned a strict rule, there's always an exception, isn't there? And you can bet that ICAI loves to test you on these exceptions. So that super harsh rule from Section 80, it actually has two very important lifelines that you need to know for your exam. And here they are. These are your two get-out-of-jail-free cards. A loss from house property and unabsorbed depreciation. These two are special. They can be carried forward even if you file a belated return. This is a classic MCQ setup. They'll give you 4 different losses, say the return was filed late, and ask which loss can still be carried forward. The answer is always going to be one of these two. So, once you've earned the right to carry a loss forward, how long does it last? This table gives you the time limits. You'll see that most of the common ones, like house property, regular business loss, and capital losses, they all get 8 assessment years. But look at the speculative items. The speculation business and racehorses, they only get 4 years. And then there's the real standout, unabsorbed depreciation. It can be carried forward indefinitely, forever. That makes it super unique and really powerful.
We've nailed down the business loss rule. So now let's get back to that problem from the beginning. The main event, the house property loss.
This number right here on your screen, this is the key to everything. 2 lakh rupees. You need to burn this number into your memory. This is the absolute maximum amount of house property loss you can set off against any other head of income in a single year, assuming you're under the normal tax regime.
And this slide right here perfectly illustrates the trap. If you're in the normal tax regime, you can set off your house property loss, but it's capped at that 2 lakh rupee limit. Anything above that, it gets carried forward. But, and this is huge, if you're under the default tax regime, Section 115 BAC, you can't set off that house property loss against other heads at all. And even worse, that loss you couldn't absorb, just poof, it's gone. It lapses, you can't even carry it forward. This is a massive difference and a perfect place for ICAI to test.
Whew, okay, that was a lot, but we have all the rules now. And now for the really satisfying part. Let's apply them to Mr. A's problem and actually get the right answer.
So, just to refresh our memory, here are Mr. A's numbers. A salary of 4 lakh, house property loss of 220, business loss of 1 lakh, and 80,000 in bank interest. And for this, we're going to assume he's under the normal tax regime.
All right, let's do this. Step 1. Let's tackle that house property loss. The total loss is 2,20,000. But what was that magic number? 2 lakh. Exactly. So, we can only set off 2 lakh rupees against his salary. So what happens to that other 20,000? Simple. It gets carried forward to the next year. Okay, next up is the business loss of 1 lakh. Now, can we set this off against what's left of his salary? Nope. Remember, salary is the fortress. We can't touch it with business loss. But we can set it off against other income, like his bank interest. So we'll use that 80,000 of bank interest to absorb 80,000 of the business loss. And the remaining 20,000 of business loss, that also gets carried forward. So let's put it all together now. His salary of 4 lakh gets reduced by the restricted house property loss of 2 lakh. That leaves 2 lakh. His bank interest of 80,000 is completely wiped out by the business loss. So what's his total taxable income? 2 lakh rupees. That is the correct answer. See? Not so bad when you know the rule. But listen, getting the right number is only half the battle. Now let's talk about how you present your answer in the exam hall to make sure you get every single mark that you deserve. This is super important.
Just follow this simple 3-step blueprint.
First, always start by stating the relevant legal provisions. Mention Section 71 for interhead setoff. If you really want to impress, mention Section 71(3)(a) for the house property restriction. Second, show your math clearly in a nice, clean table. And third, and this is absolutely crucial, write notes for the examiner. Just add a line explaining why you did what you did. A simple note like, as per Section 71(3)(a), loss from house property set-off is restricted to 2 lakh rupees, shows the examiner you know the law, not just how to use a calculator.
Let's break this down into a simple 4-step plan for your exam. First, always structure your answer headwise: salary, house property, capital gains, and so on. Second, for every single set-off, show it with a clean less line. Don't make the examiner search for your work. Third, and this is the absolute game changer, write a note for every single thing you do, and even for the things you don't do. So if you decide not to set off that LTCL against SCG, you write a note explaining why, citing the rule. That's how you prove your mastery. And finally, step 4, end with a clean summary of any losses that are being carried forward. Follow these 4 steps, and you are building an answer that deserves full marks.
So, the crucial point is, the answer to can you set off any loss against any income is a huge, resounding no. Real mastery in this topic doesn't come from knowing the general rule. It comes from knowing the exceptions, the restrictions, and the limits. That's where all the marks are hidden.